All right, welcome everyone to the fourth in the 8-part series that the Women's Business Development Center is happy to be working with the IRS on. I'm going to in a minute turn it over to Mike Madrasik to talk about the home business deduction, which is an important topic that a lot of folks either don't take advantage of or take misadvantage of, and so it's good to know what the rules are for that. The Women's Business Development Center, if you don't already know, is a nonprofit based in downtown Chicago, but serving 9 Midwestern states. We help businesses of all types, not just women-owned businesses, from pre-venture all the way up to succession planning and transition. Again, this is the fourth of a series of sessions. So if you have not registered for lessons 5 and 6, which are next week, and 7 and 8, which are the following week, go to our website, WBDC.org, and you can look in the calendar of events and see if there's topics that are of interest to you. I think now the other housekeeping item I wanted to say was if you have questions, you can put them in the chat. Mike is very generous with either answering them if it's of a general nature or if it's something he needs to research, he will do so. And I just want to call out Cynthia Duke, whom I've never met. But Cynthia, you have been at all of the lessons so far, and you were always the first person on. So we want to give you a gold star and say thank you for joining us. And now I am going to turn it over to Mike.
Thank you, Karen. And thank you, everyone, for being here today. Really appreciate the opportunity to bring this information to you. I do work for the IRS. I'm in the Chicago office, and I work for an organization in IRS called Stakeholder Liaison, and we work to create partnerships with organizations like the Women's Business Development Center and other small business organizations, bringing IRS information about small businesses, taxes, IRS procedures, policies, all trying to bring that education to you. Today, we're talking about a deduction that is available in the federal tax code for the business use of your home if you qualify, and we'll talk about the qualifications. So this is today's lesson. It is lesson 4 of 8. We've got more coming up in the next 2 weeks, so I hope you can join us for those, as Karen mentioned. So let's go to a publication. This is a screenshot of a publication devoted to providing you with information about this business use of the home deduction, publication 587. As I go through today's presentation, we hope to point out a bunch of IRS resources for you that you can use going forward. This is one of them, and everything that we present here is free to you. All you need to do is go to irs.gov, look up the publication, and print it out or save it to your computer, whatever you want to do. But as you can see here in the contents, the first section, qualifying for a deduction, provides the information in more detail than what we will provide for you today. We provide an outline. Details are provided here in the publication. It also provides information to help you figure the deduction if you want to do it yourself. Of course, we understand a lot of small business owners use tax professionals, but by providing this presentation here today, at least gives you an understanding of a deduction that you should be talking about with your tax preparer if you're using one, and if you're using your home as part of your business. There are special rules if you use the home as a daycare facility, and there's some other information that you see on the screenshot. So we'll be talking about calculating and claiming the deduction for business activities in the home, business use of the home, requirements to qualify for a deduction, if you're using part of the home for business purposes. We'll look at determining the business percentage of the home that's being used. What types of actual expenses can be deducted, which are expenses associated with the home. Determine deduction limits. There are limits as to the amount you can deduct for a home business use deduction, and where you can deduct the expenses on your tax return. So let's start with the definition of a home. As you can see on the screen, a home, can include a house, an apartment, a condominium, mobile home, similar properties which provide basic living accommodation, and structures on the property, such as an unattached garage, studio, barn, or greenhouse. So that's the definition of home in the home deduction sphere that we're going to be talking about. Now, we'll talk about two methods to determine the deduction for the use of the home office. And the first one we're looking at is right here on the screen. It's called the Simplified Home Office Deduction. That first bullet point says easier than the standard method. Well, the standard method will be a look at the various individual expenses associated with the use of the home, such as insurance, utilities, things like that. In the standard deduction, and this is something that the IRS has created to make it easier for those who would like to take a home office deduction. It's used to determine deductible expenses for qualified business use of the home. That standard method in that first bullet point and then the third bullet point can be complex and burdensome. The simplified method is intended to reduce burden, and it's capped at $1,500 per year based upon a simple $5 per square foot up to 300 square feet. So if you're using exactly 300 square feet for as your home office business use in the home, you take that $5 times the 300, or if it's less, obviously $5 times whatever that square footage amount is, to come up with the simplified home office deduction. So that's an explanation of that simplified home office deduction. If you choose to use the simplified home office deduction, you can elect to use either the simplified method or the standard method that we haven't really gotten to yet. You can use either the simplified method or that standard method for any taxable year, but you cannot later change to the other method for the same year. You cannot use the simplified method and deduct actual expenses. So you can't, in essence, double dip, is what they're saying in the third bullet point. The amount allowed is in lieu of a deduction for the actual expense, which is that standard method that we'll be talking about in a few slides here. Now, if you're using the simplified home office deduction, you'd report that deduction. And well, here we're using the example of a Schedule C. If you're a sole proprietor and you're filing the Schedule C, which is part of the Form 1040, and again, that Schedule C is profit or loss for business, you'd report that deduction on the Schedule C. There is a worksheet in the instructions for Schedule C that you can use to calculate the simplified method dollar amount. I'm going to show you here a screenshot from the Schedule C. And if you look about halfway down, On line 30, it identifies the spot where you would document the dollar amount of the expense for the business use of your home. So it's just in that location on line 30. As it says there, don't report these expenses elsewhere. And there's a form 8829 that we'll be getting to under the other method that you would attach to this Schedule C, and it is being used to help you calculate under that standard method. Here's a look at the simplified method worksheet, which is part of the Schedule C. So you can see there, it takes you line by line to determine the simplified method amount if you're using, if you're doing this yourself. So let's talk about how you can qualify for the business use of the home deduction. And here we're going to start with the exclusive use test. So you've got to meet these certain requirements that we're going to go over here on this slide and the next few slides. To qualify to deduct expenses related to the business use of part of your home, you've got to meet these requirements. And to qualify to claim expenses for the business use of your home, you've got to meet this following test for the exclusive use. First, your use of the business part of the home must be exclusively used for your business. So that part of your home has to be used exclusively for your business. That use must be regular, in addition to it being exclusive, and it must be for your business. Continuing on, so that's the business part of your home must be one of the following. So let's look at this. Your principal place of business or a place where you meet with patients, clients, or customers in the normal course of your business, or a separate structure not attached to your home that you use in connection with your business. So again, the business part of your home is what we're looking at here. And it's got to be your principal place of business or a place where you meet patients, clients, or customers in the normal course of your business, or a separate structure not attached to your home that you use in connection with your business. Let's look at an example regarding the exclusive use test. So Ruth is a graphic designer. Her computer is in the family room, and that's where she does her design work. Her family also uses the room for recreation. So the question is, can Ruth claim a business deduction for the use of the family room? And what we'll find out is that no, the answer is no. Ruth does not use the family room exclusively for her business, so she cannot claim a business deduction for its use. So focusing in on that exclusivity. Here's another test. So here Greg brews natural sodas in his garage. The garage is not attached to his house, and he uses this garage only for brewing and selling. One part of the garage is used for the brewing, and another part of the garage is where he conducts tastings and sells the soda. So does Greg meet the requirements of the exclusive use test? In here, in this scenario, we find that the answer is yes, and that Greg can claim a deduction for the business use of his garage because the use is exclusive, regular, and for his business. Continuing on with the exclusive use test, There are some exceptions to the exclusive use test, and that's what we're looking at here. You do not have to meet the exclusive use test if you use part of your home for the storage of inventory or product samples, or if you use part of your home as a daycare facility. Storage of inventory and daycare facilities have separate requirements. So let's now talk about the regular use test. We just finished up on the exclusive use test. Let's look at the regular use test. To qualify under the regular use test, you must use a specific area of your home for business on a continuing basis. You do not meet this test if your business use of that area is only occasional or incidental, even if you do not use that area for any other purpose. So let's look at this little test here. It says, Tom is a painter. He has a separate studio in his home that he sometimes paints in. Most of the time he's painting outdoors. Can he claim a business deduction for the use of his studio? And we here find that the answer is no, that Tom cannot claim, but this is just a deduction for the use of a studio. He uses the studio only occasionally and not on a continuing basis. So it's really that second bullet point that makes the point. Let's look at principal place of business. So the final test regarding the use of business use of the home is the principal place of business test. Now, you can have more than one business location, including your home, for a single trade or business. One way to qualify to deduct the expenses for the business use of your home is if your home is your principal place of your business. To determine this, you must consider all the facts and circumstances. Your home office will qualify as your principal place of business for deducting expenses for its use if you use your home office exclusively and regularly for administrative or management activities of your trade or business, and have no other fixed location where you conduct substantial administrative or management activities of your trade or business. So, what's considered administrative or managerial activities? Now, common activities would include billing customers, keeping books and records, ordering supplies, setting up appointments, and forwarding orders or writing reports. Now, activities that do not disqualify your home office include there are activities that you might think disqualify your home office as your principal place of business, but they don't. For example, employing others to conduct your administrative or management activities at locations other than your home, or two, conducting administrative or management activities at places that are not fixed locations of your business, such as in a car or a hotel room, does not disqualify your home office as your principal place of business. Occasionally conducting minimal administrative or management activities at a fixed location outside of your home also does not disqualify your home office as your principal place of business. Finally, the last activity that does not disqualify your home office as your principal place of business is conducting a substantial, not administrative or non-management business activities at a fixed location outside of your home and having a suitable space to conduct administrative or management activities outside of your home, but choosing to use your home office for those activities instead. Let's do a test here. Here, Jim is a self-employed plumber. Most of his time is spent at a customer's home and offices installing and repairing plumbing. A small office in his home that he uses exclusively and regularly for administrative or management details of his business. And Jim doesn't do his own billing. Instead, he uses a local bookkeeping service to bill his customers. Does Jim's home office qualify as a principal place of business? And here the answer is yes. He uses the home office for the administrative or managerial activities. His choice to have his billing done by another company does not disqualify his home office as his principal place of business. And Jim's business meets all the qualifications, including principal place of business. So let's look at meeting place for customers test. You can qualify, or your home can qualify under the meeting place for customers test if you use your home to meet with patients, clients, or customers in your home in the normal course of your business. Deductible expenses for part of your home are used exclusively and regularly, and you physically meet with customers and use your home, and the use of your home is substantial and integral to the conduct of your business. That's the meeting place for customers test. Let's do a test on that. So Sarah is an interior decorator. Clients visit her, to look at samples and patterns. The room designated exclusively for this purpose, and she conducts all administrative and management functions there. So she's got a room designated exclusively. After the clients decide on what they want, she spends the rest of the project at their home. Does Sarah's home office qualify as a principal place of business for deducting expenses for its use? And that answer is yes, that Sarah's home office does qualify as a principal place of business for deducting expenses for its use under the meeting place for customers test. She meets with clients in her home in the normal course of her business. We also talked about separate structures. Separate structures include freestanding structures such as a studio, a garage, a studio shed, or a barn. And it does not have to be your principal place of business or a place where you meet patients, clients, or customers. You can deduct expenses for a separate freestanding structure, such as those mentioned in the first bullet point, if you use it exclusively and regularly for the business. And the structure does not have to be your principal place of business or a place where you meet patients, clients, or customers in that case. Let's look at a test regarding the separate structure test. And in this situation, Joan builds custom designed furniture in her detached garage. When clients and Joanne discuss the plans together, they talk in the dining room, not in that detached garage. Does her garage qualify as a separate structure? And the answer is yes. Joanne's garage is a separate structure and is used exclusively and regularly in her business. She does not have to meet clients there to be eligible to deduct the expenses for its use, subject to a deduction limit. So let's talk about deduction limits. Because most home businesses are run from a part of the home rather than the whole structure, most expenses related to the business use of your home are limited to a percentage of your home used for business, also known as the business percentage, that first bullet point. To calculate the business percentage, compare the size of the part of your home that you use for the business to your whole house. You can use any reasonable method to determine the business percentage, but we're going to discuss two commonly used methods for figuring the percentage, and that's the area method and then the number of rooms method. Talk about the area method first. So in the area method, divide the area used for business by the total area of your home. As an example, if your office is 240 square feet and your home is 1,200 square feet, your business percentage is 20%. Now let's look at the number of rooms method. To use this method, divide the number of rooms used for business by the total number of rooms in your home. You can use this method if the rooms in your house are all about the same size. For example, if you've got 10 rooms in your house, you can use one of them for your office, or if you use one of them for your office, your business percentage is going to be 10%. So to record the business percentage of your home business, you would use Part 1 of IRS Form 8829, which is entitled Expenses for the Business Use of Your Home. The two types of expenses related to using your home for business, those related to the business activity in the home, but not to the use of the home, and then the business use of the home. And in the business use of the home, you've got direct expenses, indirect expense, and unrelated expenses, and that's what we're going to be talking about over the next few slides. So these are expenses related to business activity in the home. These expenses are the ordinary and necessary expenses such as advertising, business taxes, car and truck expenses, salaries, supplies, and travel. These expenses are not limited to the business use of the home percentage or the deduction limit, and they are deductible in full on, in our example, Schedule C, Form 1040, which is the profit or loss from a business. So what they're saying, in a maybe in a kind of a cloudy way here, is these are just ordinary and necessary business expenses, the advertising, the business taxes. They're not related to the business use of the home. But now we're going to talk about expenses that are directly related to the business use of the home. And there's three types: direct expenses, indirect expenses, unrelated expenses. So let's start with direct expenses. Direct expenses are expenses only for the business part of your home, and these expenses are generally deductible in full unless subject to the deduction limit, which we'll be discussing soon. A good example is painting or repairs made only in the area used for business, or having high-speed internet service for your business, so you can advertise business through your website and communicate via email with your customers. Let's now look at indirect expenses. Indirect expenses refer to the expenses for running your entire home, but are deductible based upon the percentage of your home used for business. They may also be subject to the deduction limit. Examples of indirect expenses are homeowners insurance, utilities, and general repair, such as a new roof or gutter cleaning. Now, the last item there, unrelated expenses, are expenses from the parts of the home that are not used for business, such as lawn care or improvements to rooms not used for business. These expenses, the unrelated expenses, are not deductible. The business part of these expenses can be used to calculate your business use of the home deduction. And here we're talking about real estate taxes, deductible mortgage interest, qualified mortgage premiums, and casualty losses. Certain expenses are deductible only if you use your home for business, and that's the insurance, rent, repairs, utilities, services, and depreciation on your home. Deduction limits. There are limits, and that's what we're talking about here. If your gross income from your business, operated or managed from your home, equals or exceeds your total business expenses, you can deduct all of your business expenses. If, however, the gross income from that business is less than the total business expenses, your deduction for certain expenses for the business use of your home is limited. These expenses are limited to the gross income from the business use of your home minus the following: ordinary necessary business expenses, as well as the business part of the expenses, such as your mortgage interest, real estate taxes, and casualty losses that you could deduct even if you did not use your home for business. Expenses that cannot be deducted because of the deduction limit can be carried forward to later years, subject to the deduction limit in those years. So what that is saying is that if you cannot deduct it fully in, say, year one, you can take the part that hasn't been deducted in year one and take it and apply it to year two, subject to the limits there in year two. If you file Schedule C, you calculate expenses related to the business use of your home on Form 8829, which is entitled Expenses for the Business Use of Your Home. And you report the deductible amount on that Schedule C. Here is the Form 8829, Expenses for the Business Use of Your Home. Here, again, you're identifying the actual expenses that we've been talking about over the last few slides. You're not using that standard $5 per square foot deduction, which was you identified in that worksheet that we saw at the beginning of the presentation. So this is, again, the form you're using when you're using the actual expense method, where you've identified those expenses we've just talked about, and you're going to identify them here on this form. This is part two of that same Form 8829. So you can see all of the different line items that we've discussed over the past few slides. Insurance, rent, repairs, utilities, real estate taxes. So as again, I mentioned, we're identifying actual expenses associated with the use of that part of your home you're using for business. This is the Schedule C, and whether you use that standard dollar amount per square foot or the actual expenses, you're identifying the final total here at line 30 on Schedule C. Again, if you're using that Schedule C, profit or loss from business, sole proprietorship. So what you can't do is take a double deduction for real estate taxes and mortgage interest. So say in your calculation, 20% of your home is used for business purposes, and you can take 20% of the real estate taxes and the mortgage interest as a deduction, an actual cost deduction for the business use of your home. You can't then, and it's been limited a lot over the last few years because of tax law change that has been put in place, where not as many people now can take a deduction on their federal tax return for real estate taxes and mortgage interest, or it's limited. But you can't take a double deduction. So you can't take that 20% as a business deduction and then take the full 100% as a deduction on another part of your tax return, the Form 1040. That's what the first bullet point is trying to emphasize there. Again, that business portion, that 20% in our example, you're reporting on Schedule C. And the personal portion was reported on Schedule A of the Form 1040, which is where you identify itemized deductions if you can take itemized deductions on your Form 1040. So that fourth bullet point is again emphasizing you can't double dip. You've got to allocate a portion to the business use that's reported on Schedule C, and the other portion, if you can take the deduction, is identified on Schedule A to come up with the total, in this case, mortgage interest or real estate taxes. IRS Publication 587, Business Use of Your Home, is the publication that we want you to go to get more information on business use of the home. Excuse me. Now, if you use your home for business purposes, some special rules do apply when you sell that home at some point for a profit. You would have to pay tax on part of the gain associated with the sale of the property. You'd pay tax on part of that gain that is equal to what you claimed or could have claimed for depreciation over the years. So if you took a depreciation, if part of the deduction for the business use of your home is related to depreciation, and depreciation is simply, say you bought a home for $50,000 and you use 20% of it for business purposes year after year. Depreciation is taking that $50,000 cost, and that has to be just for the building itself, because you can't depreciate the cost of land. But if that $50,000 and the tax law says you can depreciate that $50,000 cost over 20 years, and you own the property for 20 years and you've depreciated that cost over 20 years, when you come to sell the property, the depreciation amount that you claimed over that 20-year period would be taxed. That is part of the gain. So more information on that is available on IRS Publication 523. So what you want to do when you have that situation is you want to keep records in that scenario for that full 20-year period, so you can determine how much of the cost was depreciated over that time period. And you'll need that when you do the calculations on the profit from selling the home. So it's that's what the last bullet point is pointing out. We just want to make you aware that there are, unfortunately, individuals and organizations out in the world that try to trick individuals into falling for these scams and schemes that use tax deductions and tax credits, but what these individuals and organizations do is sell false credits and deductions. So we want you to be aware that be aware of these, and you can go to irs.gov to find out more information on how to avoid these schemes If you just go to the website and in the search box, type in scams and schemes, you'll come up to a site where you'll get more information about those. So please beware that there are people out there trying to sell you phony tax schemes. So kind of summing things up here, we went through two options to calculate the amount of the deduction. Over on the left-hand side of the screen, you've got the simplified option, where the deduction for home office use of a portion of a residence allowed only if that portion is exclusively used on a regular basis for business purposes, and the allowable square footage of home use for business, you can go up to a maximum of 300 square feet. Under that simplified option, you're multiplying that standard $5 by the square footage to come up with the simplified deduction amount. On the right-hand side of the screen, my right-hand side of the screen, you're looking at the regular method, and the deduction for the home office use of a portion of a residence is allowed only if that portion is exclusively used on a regular basis for business purposes. There's no difference with the simplified option. But under the regular method, you're using a percentage of the home used for business, and then you're using actual expenses, and you've got to identify and keep the records that identify and document those actual expenses under that regular method. A little more information about the two methods. Under the simplified option, the home-related itemized deductions, again, that 80% of the real estate taxes and the mortgage interest that is not related to the 20% of the property used for strictly for business purposes, that 80% can possibly be deducted on your Schedule A of your Form 1040, which is the individual income tax return you file with the IRS. Under the simplified option, there's no depreciation deduction. I just gave a short example of what depreciation is. So under that simplified option, in that $5, there's no allowance there for depreciation. And under the simplified option, there's no what we call the recapture of that depreciation on the sale, where the depreciation amount you use under the regular method, that there is no depreciation. So you don't have to worry about, when you sell the home, a possible tax on that depreciation amount that you took over the entire time that you had a deduction for the business use of the home. Under the regular method, those home-related itemized deductions are a portion between Schedule A and the business schedule. The business schedule we've been talking about is the Schedule C, where a sole proprietor identifies the results of the operation of their business to the IRS. That Schedule F is for a farming operation. So under the regular method, the depreciation deduction for a portion of the home used for business can be determined and used, but if you do that, you're going to have recapture of depreciation on the gain of the sale of the home. Recapture simply means there'll be a tax on that depreciation amount that you took over that period of time that you deducted under the regular method. Just some more information regarding the simplified method and the regular method. The deduction cannot exceed gross income from the business use of the home, less the business expenses under both the simplified and the regular method. Under the simplified method, the amount in excess of gross income, the gross income limitation, may not be carried over. I mentioned under the regular method, if you've got a deduction that exceeds the limit in year one, you can take it over that excess over into year two. So that's pointed out there in the middle row. So just some more information on both of those methods. Again, business use of your home, the employee expenses for business use of the home um, is no longer allowed. At one point, if you were an employee of an employer, not self-employed, the expenses for business use of the home was allowed. That's no longer allowed. I mentioned earlier, if you've got both business use and personal use expenses, such as the real estate taxes and the mortgage interest, you cannot deduct more than $10,000 if you're married filing joint, or $5,000 if you're married filing separately. Um, uh, uh, on your Schedule A, excuse me. Here we're talking about those the not the business part of the expense, but the individual portion. With again, the individual portion of the real estate and the mortgage interest in our example. That Form 8829 is used to figure all the allowable expenses for business use of your home on Schedule C when you're using the actual expense method, that method that we talked about. So here is the Form 8829, some screenshots. Part one, part of is identifying the part of your home used for the business. So you're coming up with the percentage in part one. Then in part two, you're figuring your allowable deduction. And I see there that they've listed line by line the types of expenses that can be associated with the business use of the home. Casualty losses are losses where, for example, there's a disaster or a tornado, and there's a disaster hits your home, and there is a loss associated with that disaster. Deductible mortgage interest, real estate taxes that we've been identifying. So that's 8829 on the left-hand side, my left-hand side of the screen. Schedule A that we've been referring to is over here on the right-hand side of the screen. That's where the individual portion of the expenses, such as the mortgage interest and the real estate taxes, would be deducted on your individual return on Schedule A. So in review, we talked about the requirements to qualify for the deduction, determining the business percentage, the types of deductible expenses, those limits, where you can deduct these items on your tax return. We talked about the effect if you sell your home and you've been taking the depreciation deduction as part of that business use of the home deduction. The really important part of keeping records, because every item that you identify on your tax return that's submitted to the IRS, if you were audited, you've got to have records that back up the numbers. You also need to provide your tax return preparer with documentation to support the numbers that are identified on the return. We talked about tax avoidance schemes. Go to irs.gov to get more information. And the two methods, that simplified method and the standard method. This is publication 587, again, business use of the home. We do have other resources on irs.gov. This is if you to go to irs.gov and type in topic number 509, business use of the home, more information on what we discussed here today. The simplified option, there's information on irs.gov as well. There's frequently asked questions. We try to anticipate questions. We also receive questions from taxpayers over the years. Those get put into the FAQ section, trying to anticipate questions you might have. That's my contact information, and I'm more than happy to help in any way that I can if you've got some questions. But I want to thank you again, thank the WBDC, and thank Karen for the opportunity to present to you today. And with that, I'll turn it back over to Karen.
Mike, thank you so much. I am going to stop the recording.